Hello and welcome. What if one of America's biggest lenders slowly started stepping away? Because that's exactly what may be happening right now. China has reportedly instructed banks to reduce exposure to U.S. Treasury bonds. And while markets haven't panicked quite yet, the long term implications could be massive for U.S. debt, interest rates, and the stock market. This isn't a panic move, it's not a market crash, but it could be the early signal of a world slowly preparing for a future with less U.S. financial influence. And if that trend accelerates, the ripple effects could hit interest rates, mortgages, corporate borrowing, and your stock portfolio. Today, we're breaking down why China is doing this and what it means for the U.S. economy, and the stocks or sectors that could feel the impact first. First, let's look at what China is actually doing. Recent reports say Chinese regulators told banks to reduce U.S. Treasury exposure, officially citing risk management and market volatility. But many analysts believe there's a bigger strategic reason, which would come down to reducing dependence on the U.S. financial system and preparing for geopolitical tension scenarios. China has already been slowly cutting Treasury holdings for years, and total holdings recently dropped to around $683 billion. Reports say the lowest since 2001. Now, we want to point out this is not a sudden dump. It is a slow, strategic diversification, often into gold or other reserves. Some analysts warn that if foreign demand falls long term, Treasury yields could rise. Others say short term market impact is limited. So the question is, why does this matter to the United States? The U.S. relies on global demand to finance debt cheaply. If China or other countries buy fewer treasuries, bond prices could fall, treasury yields could rise, and U.S. borrowing costs could increase. If yields rise, that could ripple into mortgage rates, corporate borrowing costs, and stock valuations, because stocks are priced partly against bond yields. Now, if safe bonds pay more, investors sometimes move money out of stocks. But here's the nuance. Markets recently shrugged off some of these reports, meaning investors think the transition will be slow and manageable. So, what could be a potential stock market impact? If Treasury yields trend higher over time, here's where we could see the impact at U.S. banks. Higher rates can help banks earn more on loans, but if rates rise too fast, loan demand could drop, and that would lead to an increase in credit stress. That is, if the economy slows. This could essentially impact financial institutions and regional banks. Now to the impact on high growth tech. This could be negative if yields rise. A global slowdown risk could hit chip demand. This could have an impact on tech and high growth stocks like Nvidia, who rely heavily on future earnings. Higher bond yields make those future profits worth less today. Real estate and utilities are also rate sensitive. These sectors depend heavily on debt financing. If borrowing costs rise, real estate margins shrink, utility dividend appeal weakens, REITs and utility ETFs often react quickly to rate spikes. So here is the bigger global picture. The real story isn't China versus US. It's the slow evolution of the global financial system. China appears to be diversifying reserves, reducing dollar dependency, and hedging geopolitical risk. In the short term, it's likely manageable, but in the long term, it could reshape global capital flows, and that is what markets are watching. If you want macro breakdowns like this, hit subscribe. Drop a comment. Do you think this is normal reserve diversification or the start of something bigger? We'll see you next time.